The Liberation Day market massacre seems like ancient history. Worries about a slumping economy have faded. Stocks are hitting all-time highs after one of the biggest post-correction rallies on record. But the US dollar is having its worst year in more than a half century. Jay Powell is continuing to sit on his hands rather than cut interest rates at the Fed. And while the big, beautiful bill looks like it'll pass, one likely consequence is that US deficits and debts will continue to grow. To help you sort out the opportunities and risks in this environment, I've brought in two of the sharpest experts in the Money Show roster. They have some very interesting things to say about the real risk of recession, the myths and realities of American exceptionalism, and the market outlook for the brand new second half of 2025. They're Alejandra Grindal, Chief Economist at Ned Davis Research, and Kristina Hooper, Chief Market Strategist at Man Group. Welcome both of you to the Money Show Money Masters Podcast. Well, I appreciate you both joining me here for this podcast. Obviously, we've got a holiday weekend, long weekend coming up here, so hopefully everything's going well. You've got some fun plans to look forward to. But in the meantime, I guess I'll start with you, Alejandra. How would you sum up the economy in a nutshell here? I mean, are you genuinely sanguine, worried, exuberant, or is there maybe a different adjective you'd use to describe where things stand?
Well, as you can tell by my facial expression, sort of okay. So I, first of all, as a global economist, just wanted to make the distinction with where we see global economy versus US economy. But overall, with the US being the world's largest economy and having impacts all over the world, the patterns tend to go hand in hand. So I would say with respect to both the global economy and the US economy, I think things are going, sort of okay. Our outlook for the US economy and global economy is below potential growth, however, no recession. So overall, very consistent with this sort of okay view that I mentioned.
Got it, okay. And Christina, I guess from sort of that top-down perspective, I mean, how do you characterize where we stand just here in the start of the second half of the year?
So I would say that I'm a lot more concerned about the US economy than I am about other economies. I just believe that there are a number of different policies that could combine to create something of a perfect storm for the US. Certainly hasn't shown up in the data yet, although we have gotten some indications in the soft data that consumer sentiment has declined. Now, we did see a recent recovery, but still rather negative sentiment, rather high inflation expectations, and I think that's only going to get worse. And I'll just give you a few of the policies that I think are really going to be problematic. First of all, government spending cuts. I actually went back today and listened to Ross Perot, one of my personal heroes, his infomercial. You may recall in the early 1990s, he was a debt vigilante. And he talked about how trickle-down economics doesn't work, how we need to get the deficit under control. And we're not getting our deficit under control. It's growing. And where we are cutting government spending is in the high multiplier effect areas. Where we are spending to a significant extent is in lower multiplier effect areas. And so that's one, in my opinion, policy error right now. And another one, of course, is aggressive immigration policy. If you are going in and deporting a lot of immigrants, the problem is that we're not going to necessarily have the people to fill the jobs that we need. And so we could have, a significant bout of service inflation. Tariffs, I don't worry about so much because that tends to create a short-term impact. But what creates a longer-term sustained impact on that leads to higher inflation can come from the labor market. So I worry about that a lot. But in general, like even student loans and the lack of forgiveness, that's going to create a lot of pressure on certain consumers. So all in all, to me, I worry about the US. But at the same time, I'm seeing more fiscal stimulus coming from areas like Europe and the UK. They've agreed to this NATO spending that will ratchet up not just defense spending, but defense adjacent, which is largely infrastructure, up to 5% of GDP in the next 10 years. I think that's huge.
Got it. Alejandro, let me ask you about a couple of those points there. I mean, obviously, as we're recording this, it looks like this one big, beautiful bill thing is likely to pass now. Thoughts on what impact that might have, and or thoughts, especially given your global focus, on where things stand in this trade and tariff saga we've been involved with?
Well, first of all, I wanted to mention. Oh, did you direct it toward me? I'm sorry.
Yeah,
Okay,
let
I
me
just
start
want
with
to
you,
make sure I heard
Alejandro.
correctly. First of all, I want to say I agree 100% with Kristina. I know in these discussions you like to have a little bit of back and forth, but I actually agree 100%. Those are some of the risks we're looking for as well. But with respect to the big beautiful bill, you're absolutely right. It looks like it's coming into fruition in some form or another. I would say in terms of the impact on the economy and inflation, I would say near term, both positive. If you look at a lot of the details within the bill, a lot of the net stimulus is front loaded. Incidentally, while Trump was still president, makes sense, right? You want to see the benefits while you're president. And then the supposed net reductions or the cost forms are set to come actually later along the road. So kind of to Kristina's point, it's sort of, yeah, we're getting the sugar boost now, but maybe kicking the can down the road. Again, holding all else constant, you add the upside risk coming from the immigration policies to inflation. You could also see upside risk to inflation just from the stimulative nature of the big, beautiful bill. So that's, I would say, kind of creating that anti-recession story for the United States, but obviously creating perhaps longer term issues as a result. In terms of the tariffs, again, like I don't have a direct rapport with the president, so I actually don't know what the end result will be. You have a lot of different folks, such as Bissett and Lutnick, kind of giving different stories out there that a lot of particular deals are intact and will be finished soon. But we've heard these same stories for a week or a month now, and they haven't really come into fruition. From at least the latest commentary I've heard, I would suspect, just because of the negative market reaction we had on Liberation Day, I would suspect that if the US is working on a trade deal with some of these larger economies, it sounds like they are. Supposedly there's 10 or 12, maybe 18 discussions. They've been jumping around with numbers intact. I suspect that 10% moratorium or that 10% that 10% inflation pause will probably remain until the deals stay in place. So that should at least prevent that huge knee-jerk reaction. So I do think peak uncertainty was probably April 2nd, but it's not completely over just because there's really just one deal in place at this point, and the clock is running short at this time.
Got it. Kristina, I wanted to ask you about your thoughts on Powell and Fed policy here. Obviously, today was another day where he kind of just said, we're sitting on our hands. There's been a few cracks or fissures, I guess, of a few members of the Fed talking about maybe we're ready to cut potentially as soon as July. What are your thoughts on what happens there? I know there's politics mixed in it, but just from kind of an economic standpoint, especially.
Yeah, well, Chair Powell made it clear that a big obstacle to doing anything other than sitting on one's hands is to get the tariff situation resolved. At this point, there's just a really high level of uncertainty. And so I think he views it as almost monetary policy malpractice to act now and make assumptions about what is likely to come, because we really just don't know how this plays out with tariffs. So I suspect that we're going to see the Fed sit on its hands for quite a while. We don't know, but I think chances are we'll get a tariff pause again on July 9th, at least for some countries. The alternative could be a lot worse if we were to see the implementation of tariffs. By the way, my understanding is that negotiations have gotten a little difficult, at least for some countries, because they want to make sure that they have an across-the-board tariff agreement, as opposed to the potential for the administration to come back later and say, we're going to put a higher tariff on chips, or we're going to put a higher tariff on certain industries. So I think the Fed is being prudent to sit and wait. And I suspect that because we're probably not going to get this situation resolved right away, that it'll be sitting on its hands until the fall. My expectation, my base case, is probably one cut this year, unless the economy deteriorates quite significantly and the Fed is forced to act sooner, especially sooner than when we have all these tariff deals sewn up.
Got it. Alejandra, what about your thoughts on the Fed here? Do you tend to agree one cut, or do you see more? And also, I'd be curious about your take. What you think is going to happen at the longer end of the curve? I've seen more questions out there, people wondering how's housing going to perform? What's going to happen with mortgage rates? I was wondering if you had any thoughts on that.
Well, so first of all, with the Fed, I'm agreed so much with Kristina. I think they're definitely in wait and see mode, too much uncertainty. They have enough time to buy for that. Inflation's doing decently well. The economy is doing decently well. So they can wait around. We suspect we'll get some good messages around Jackson Hole. Obviously, that's kind of like that interim meeting where we'll get information from Powell, and that'll let us know whether perhaps that September cut comes into fruition. If September is that first cut, I think that leaves room for a second cut. So I would maybe, different opinion with Kristina with, 2 versus 1, not dramatically different. Your second question was about the long end of the curve and longer term interest rates. There's so many different explanations behind it, but I would like to go back and just talk about the government debt story.
Sure.
We have charts where we just show a regression line between government debt versus long-term interest rates. And it's a pretty clean relationship when you compare it among developed countries across the board. And I think that's the situation with the United States. So if the government continues to spend, and it will, I mean, yes, we're going to get some tariff revenue, but it's not going to be enough to counteract the upcoming tax cuts that President Trump is intending to do, and the minimum number of cuts. And then we also have aging populations. And keep in mind that the largest expenditure of the federal government is Social Security, and no one wants to touch that. So I think in the long run, we're still going to see higher interest rates.
Got it. Kristina, I want to ask you, I mean, you just got back from a trip to the UK. We just had the worst performance of the dollar index going back to, I think, in a first half since 1973. So I'm sure that was a little more painful than it needed to be. Thoughts on why we've seen this huge move in the dollar, and also on the flip side, why we've seen such a powerful rally back from what obviously at the time looks like some pretty painful corrective activity in the market back in April.
So I think the move down that we've seen in the dollar, to a certain extent, is a retracing of strength for the US dollar for a very long time. But I also think it's a story about the US not necessarily offering the same kind of safe harbor that it had historically, especially when it comes to asset classes like US Treasuries. So I think this is, and of course, we've seen a move away from the US dollar over the last couple of years as a result of US sanctions on Russia, and that fear that exposure to the US dollar exposes you to more than just the currency. So I think that this is an environment in which we're going to see investors thinking less of US Treasuries as that safe haven asset class of choice, think more of gold. And in fact, in some ways, gold it has replaced, at least for some roles, what the US dollar had been for investors.
Okay. And then equities, and again, this is for either of you, really. Thoughts on the rebound that we've had? I mean, is this something that, from an economic standpoint, from sort of, market-based or earnings standpoint, that you think has legs, or you think this is a story of too far, too fast?
I think it's too far, too fast, especially when we look at valuations where they are today. I mean, if we were to just take cyclically adjusted PE ratios, typically we see a significant fall from here when we reach these levels in terms of valuations. I think the stock market is not factoring in, not accurately assessing recession risks. And I think it's because it's very hard to make assessments. We have so much uncertainty. It's hard to model out how tariffs will impact the economy. It's hard to model out how immigration policy will impact the economy. But I would say I do think that where we are today, investors are looking at US stocks with rose-colored glasses.
Got it. Now, Alejandra, I know, again, as an economist, you kind of look at things a little bit differently, but I mean, one thing that stood out to me from a market standpoint is just the incredible outperformance we've seen in a lot of foreign markets vis-a-vis U.S. markets. And I know some of it is, if you're a U.S. investor, you get a currency kicker by investing overseas. But in general, is there, from an economic standpoint, do you think the prospects are better in a lot of these foreign markets? Do you think some of the things like the European defense spending and so on that Kristina alluded to is going to change the composition of where the growth is?
I think in the intermediate term, there definitely are opportunities. Longer term, I think that's still up in the air. Are we, kind of going back to that question, are we seeing the end of US exceptionalism? Have those long-term growth drivers that have made the US exceptional, are they gone? But moving back to intermediate term, yeah, I do think there are some pretty good opportunities. And I think a lot of it goes back to where was growth expected to be at the beginning of the year versus where it's probably going to end up to be. And in the case of the United States, I think most people started 2024, or sorry, started end of 2024, started 2025 pretty optimistic with strong growth prospects for the United States. And now we've been revised down, not just ourselves, but other folks, to a well below potential rate. Whereas if you look at Europe, you look at China, those were initially economies that were viewed as being very vulnerable to the US and a big target of President Trump. But our research found that their economies actually have relatively small exposure to the US through exports. Canada is much larger, Mexico is much larger, Vietnam. So it actually makes sense why those economies are willing to negotiate a bit more. So I think it's more along the lines of expectations and that surprising resiliency of some emerging markets as well as Europe versus what was originally expected. Now, going to the longer term picture, that's really what's sort of up in the air. If you look at long-term growth in the United States, especially when you compare it to developed or other developed economies, really no other economy comes close. However, if you were to ask me a year ago, is there an end to US exceptionalism from a relative growth perspective? I would say I don't really see anything. Whereas this time around, there are elements that could reduce within policy that could reduce potential. So as Kristina mentioned, immigration policy, one of the big positive drivers of the US economy has been the labor force. And since the pre-pandemic baseline, the only growth we've seen in the labor force has been in the foreign-born population. So if we see a reduction in both voluntary and involuntary migration, that's going to reduce potential growth. And then from the productivity side, tariffs by definition, reduce comparative advantage and reduce productivity, which also ultimately reduces US potential growth. Now, if I can end at least with a positive note, there's still a lot of great things in favor of the US economy. We're energy independent, which is quite different from most other developed and even many emerging markets. And then we're also less regulated. We could even see more deregulation with some of the policies within the tax bill, and then or the big beautiful bill. And then we also have much more fluid labor markets. We're also the epicenter of AI. So I still think there's still a lot of positive arguments for the US, but you could see a little bit of a leveling in the playing field, which in the long run could create, just here and there more opportunities outside of the US.
Sounds good. Kristina, in the time we have left, any kind of sleeper ideas or sectors or groups or asset classes we maybe haven't talked about yet, but that intrigue you? Again, it's always, we're turning the page on a new half a year, so I'm just kind of thinking if there's anything that is worth investors really paying attention to here.
So I don't know if I'd call them sleepers because I've been talking about them for a while now, but I think there's a heck of a lot of opportunity in European equities and to a lesser extent, UK equities. My rationale is that valuations are low. So expectations are low, and there are those positive catalysts, most notably, of course, that increase in fiscal stimulus. So you've got not just low valuations, high dividend yields, higher buyback yields. To me, that's a winning combination. I think that suggests there's significant potential there. I also am very excited about China tech. I think that there hasn't been a lot of attention being given to China tech since the announcement around DeepSeek, and that was a while back now, almost 6 months ago. But I think there is a growing recognition that China tech in a number of industries is comparable to US tech and very, relatively low valuations when compared to US tech. So I think there's a very significant opportunity there as well.
Got it. Now, Alejandra, both of you are going to be joining us for the Global Investing Opportunities and Risks. I can't forget that word, the expo we're having in a couple of weeks. When someone comes to your presentation, any idea, like thoughts on what you're going to tell them or what kind of takeaways they're going to get from that?
Well, so we have a lot of interesting things and maybe some resolutions and uncertainty that can happen between now and then. So I'll be excited to talk about whether any stimulus package has gone through, any trade packages have gone through, whether any tariffs have been reinstated. But ultimately, taking this macro information, we'll have a slightly more clarity maybe at the end of this month, and telling our wonderful listeners what's the best place to put asset classes in that type of environment.
And I guess that would be my last question for you, Kristina. Specifically, any kind of risks that we haven't mentioned or things that you think are going to be important to focus on then?
Well, I do think US recession risk is much higher than most are factoring in. I would anticipate that that the US goes into at least a modest recession within the next 12 months as a result of some of the policies I've talked about.
Got it. Well, listen, Alejandra, Kristina, I really do thank you both for your time and your insights here. Viewers, if you're watching this, these two experts are going to be joining us. It's called the Global Investing Opportunities and Risks Virtual Expo. It runs July 23rd to 24th on our online platform. You can register for a free pass. Use the link in the description below. And otherwise, hope everybody has a wonderful holiday, and we'll see you online in a couple weeks. Thanks again for your time.